Good morning, everyone, and welcome to Burnie Group's M&A webinar series. Today, I'll be talking about strategies to source high-potential exclusive mid-market deals with Jonathan Tarshis Neil from TorQuest Partners. A few quick notes before we start our session today. The session will be recorded and sent to all participants after the webinar. Listen-only mode is on during the presentation, and so please submit any questions via the chat. We'll have a Q&A session at the end of the webinar. So let me welcome Jonathan to our webinar. Jonathan is a partner at TorQuest Partners with a track record of driving strong financial and operational results. He's a prominent member of TorQuest deal team and has years of experience mid-market acquisitions, which we're excited to discuss today. Jonathan will share TorQuest's approach to finding attractive mid-market acquisition targets. So welcome to our webinar, Jonathan.
Thanks so much for having me.
Jonathan, maybe as a starting point, could you give us a quick introduction to yourself, and then also tell us a little bit about TorQuest Partners?
Happy to. And Dave, thanks so much for the kind intro. I've been with TorQuest off and on for it'll be 15 years this fall. The off part was I took a break and went to business school, and then was working in an operating role for a company called Tough Mudder after business school. They did the mud run obstacle course events.
Did you participate in one?
I did a couple of them. I'm not a huge fitness person like some folks are who do them, but when you work at the company, it's you want to try the product, I guess. So I did a few, but then I rejoined TorQuest about 10 years ago, and have been here ever since. For those who aren't familiar with us, so TorQuest, we are one of I'd say Canada's original mid-market private equity funds. So our two founders, Brent Belsberg and Eric Burke, started TorQuest in 2002. Brent actually had a predecessor publicly traded private equity vehicle called Harrison that he founded in the early 90s. And so we've been in the private equity space in Canada for going on 30 years. And our focus is really on mid-market private equy deals where we're really focused on what we like to call partnership style investing. And what that means is, by and large, we are the first institutional capital provider coming into a business that is founder, entrepreneur owned and often led. And we are providing that founder or entrepreneur with capital to help facilitate any number of things. Often it's liquidity when he or she has been with the business for a long time, has a lot of his or her wealth tied up in it, and finding a way to help that person diversify their wealth. Often it's helping with succession planning, and sometimes it can be helping with growth capital, where a business has an opportunity to invest. It's a size of investment that the owners either can't make themselves or don't want to take on that level of risk, and so we step in and help with that. And so it can be for lots of different reasons, but I would say the common theme is really around those founder partnerships. Historically, we've found most of our opportunities in Canada, and we've really found that the depth of our network and relationships here has helped surface that. I think increasingly as we've grown, we've looked at more opportunities south of the border, particularly in industries where we have some experience and some comfort. But I'd say by and large, we remain, Canadian focused. We're headquartered in Toronto. That's still where we do the vast majority of our investing, and remains a very important part of our business. The last thing I'll say is we are a generalist fund, meaning we will look at opportunities across a range of industries. We don't really focus on mining or oil and gas or early stage technology, but really any what I would call old economy type industries are ones that we will look at. So consumer products, industrial products, manufacturing, those types of businesses.
Great. Well, I'm really excited to discuss what makes an attractive company for TorQuest, which we'll get into in a second. Before we dive into that, I'm curious, it's been a challenging couple of years in private equity and capital markets. Interested to get your perspective on how things are evolving. We're a quarter of the way through 2024. What's your view of where things are headed in the remainder of the year?
It's a good question. I think certainly 3 or 4 months ago, it felt like there was some optimism in the capital markets after, I think, a pretty tricky last year or two with interest rates rising and there being a fair bit of sort of geopolitical uncertainty. It felt like at the beginning of this year there was some hope that interest rates would start coming down, that the slowdown or backlog of M&A opportunities that I think we'd seen over the past 12 to 18 months would start to loosen up. I think that optimism is probably a little more tempered today. I think the view being that interest rates maybe aren't coming down as quickly as folks had hoped. There's still being a fair bit of uncertainty in the economy and sort of where that's headed. And but all of that said, I think what we're seeing is there's a big push to try and increase activity on the M&A side after a relatively slow last year or two. And so you're still seeing, I think, businesses that are strong, healthy businesses trading for attractive multiples. I think people are starting to get their heads around how to finance those businesses at higher interest rates. There still hasn't been the pickup in overall deal volume yet, I don't think, but we'll see what the rest of the year. I'd say we're still fairly we're in a bit of a wait and see mode. I think we'd like to see the gap that everyone talks about between buyer and seller valuation expectations. I think I don't know that we've necessarily seen that sort of totally shrink or get behind us, but we're very much in the market for for new opportunities. We just I probably should have mentioned this at the outset in the overview of TorQuest, but we just closed our sixth fund at over $2 billion, and so we've got lots of capital that we're trying to figure out a home for, and so we think for the right businesses you can get deals done.
That's great. Well, congrats on closing the new fund. So great opportunity to dive in then. So if there are organizations out there that are looking to partner with TorQuest, what are some of the qualities of an attractive organization when you look at a company to potentially invest in? What are the things that you look for?
So we are probably not unique in the private equity space in terms of what we think makes a business attractive. To me, it really comes down to growth and cash flow, and the question, does the business have some very clear and tangible growth opportunities ahead of it that are relatively sort of near to medium term in nature? And what I mean by that is, our time horizon for our investments is, again, fairly typical of a private equity fund. We're in most of our deals for sort of 3 to 7 years, sometimes shorter, sometimes it's longer. But in that time frame, do we see a path to a business growing materially from where it is today? So that's I think objective number one. And then the related point is, the nature of our deals is we are using debt to finance a portion of the investments that we're making. And so it's really important that these companies can generate, steady and predictable cash flow in order to service that debt and ultimately help us make a return. And so I really think those two ingredients are crucial. And I think the nuance that is, ends up being quite important to us, that is less about the characteristics of the business and more about our reason for being at the table, have to do with some of these founder and entrepreneur partnership dynamics, where if there is a business that is out there owned by a sophisticated institutional shareholder looking to sell 100% of that business to the highest bidder, it may be one that we look at, and if it's a space we know well, maybe it's something we get excited about. But more often than not, we'll say we're unlikely to be competitive here with the thousands of private equity funds that are out there that may know this business better than we do or know the industry better than we do. And so what ends up being really important for us is, do we have the opportunity to build a relationship with that founder, with that entrepreneur? Because it really ends up being a marriage between us as the private equity fund and the shareholders, oftentimes, who are rolling a significant portion of their equity alongside us and continuing to be a meaningful shareholder in the business. So do we have an opportunity to get to know that person, help tailor a transaction that meets his or her needs, and ultimately feel like we have the chance to not just get to know the person, but also to learn the business and take our time to diligence the business properly, really understand in detail what makes the business poised for growth. What about it, allows it to have a sustainable position in its industry, and because ultimately that feeds into our view of the future earnings and cash flow potential of the business. And so that relationship element for us, and maybe more so than others, becomes extremely important when evaluating an opportunity that we're likely to be interested in.
I know a lot of founders and owners are a little bit concerned about partnering with private equities and lose control, and they've all heard the stories of PEs just coming in and taking over. So it sounds like you have a bit of a different philosophy about that and continue to partner with those founders and owners.
100%. And our approach to really all of our deals is we try and have a degree of humility in how we're approaching these businesses. We don't come in thinking that we know better in terms of how to run the businesses. And so for us, it's all about backing a founder or management team who has what we think are exciting growth plans and providing them the capital to execute on those. Frankly, if we approach an opportunity and think that we have a better idea for how the business should be run, most often we just won't invest in that business, because that's a scenario where we are immediately going to be at odds with the team that's been in place running the business. And in our minds, you're taking a risk, whether it's a cultural risk or an operational risk or an execution risk, that you are going to be able to work through a transformation or disruption to that business and come out the other side of it in a better place. And that feels like a big risk to us oftentimes. Mm-hmm. And so there are lots of other private equity funds that do that very well. It's not what we feel like we do best. In our mind, the most important thing is backing a founder or management team that we have a relationship with, that we have a lot of confidence in, and making sure that that team is aligned with us and is invested in the business, because we feel like that is what sets us up best for success.
Okay, great. So if there are owners, founders out there who are excited about their organizations, driving growth through partnership with a private equity fund like TorQuest Partners, or potentially creating a glide path if they want to exit the business, what can they do to make themselves most attractive for a TorQuest Partners or other private equity firms?
I really think it goes back to, the two key ingredients I mentioned earlier around growth and around sort of sustainable cash flow. And David, you and I talking before we got on around preparing for exit and what you need to do to have a successful exit. I think a lot of those types of preparations are similar in some ways in terms of preparing for a new partnership around getting your books in order and all that stuff. But when you step back and think about what is a private equity firm likely to find attractive or unattractive about your business, it's can you articulate to that private equity firm why and how your business is positioned to grow over the next 3, 5, 7 years in a very tangible way. And so to use an example, someone who can say, I'll give an example. My manufacturing plant is out of capacity, and I have started a project to build a new manufacturing plant. And here's what the capacity is going to be. I have customer contracts signed up that are going to fill that plant, and I know I can earn these kinds of margins and these kinds of earnings from those contracts. And I've built 3 plants like this before. We look at that and say, great, that's very easy for us to understand and envision how this is going to end up adding to the growth and earnings profile of your business going forward. To use a different example, if the answer is, oh well, the business does pretty well in Canada and I'd like to grow internationally, that to us doesn't feel tangible and doesn't feel sort of clear as to how you're actually going to go about doing that. And that's and so taking the time to really put meat on the bones of this is where I see myself taking this business over the next period of time, I think is important. And then to me, the other element of around cash flow has to do with, can I demonstrate that my business converts revenue and earnings into cash flow, and that we have the ability to pay down debt if there's debt on the business. We have the ability to reinvest in the business as needed, and we have a position in our industry that has real barriers and is very hard for folks to replicate. And again, just to be more specific about it, where there is a business that we can clearly point to and say, that is really, really hard for someone to displace. It's really attractive. And, but on the flip side, where there's an industry that's undergoing significant disruption or change, and it's unclear why a given business is going to remain, as profitable or as healthy as it has, given that disruption, it becomes really difficult for us to get excited about.
Right. So I like those examples. In the first one, it seemed pretty clear cut. You've got you're running out of manufacturing space. You need to invest. You've got contracts. Why would that particular owner or founder approach TorQuest and go, use equity to finance that versus leveraging debt as then may retain full control and full ownership of the business?
I think it's a debate lots of owners have. And I think what it comes down to is risk tolerance in a lot of cases, where there are many entrepreneurs that will say, I don't want to give up equity or control in my business, and I am very happy to borrow as much as I possibly can to finance this growth. And that works for a lot of people. So there are absolutely situations where we love the business, we love the entrepreneur, and they just don't need us, and that's okay. I think the type of situation where maybe it is more relevant is you have a founder or an entrepreneur who is getting towards the end of his or her career saying, boy, this is a lot of money to be putting at risk at this point in time. I've never really liked debt. philosophically, or my values are that I don't want to be beholden to a bank or whatever it is, and so I just don't have the risk tolerance to maybe make that decision in the way that some others would. I'd be able to sleep much better at night having an institutional shareholder next to me who both can help me fund this growth, but then also who I know isn't going to be coming for the keys of the business if we have a hiccup or two, a quarter from now. And so I just think it comes down to risk tolerance.
Right. And other than providing capital, are there other things that TorQuest Partners would bring to the table to assist an organization in achieving their objectives and achieving that growth?
Absolutely. We really like to have those kinds of supports dictated by the needs of the business. And so for sure, whether it's the relationships that we have with financing sources or executives or just frankly the horsepower that we have internally here to help plug gaps in management teams or their analytical capabilities. Those are all areas where we will sort of offer ourselves up to say, hey, let us help be your arms and legs and eyes and ears in the market for opportunities or ways that we can sort of help support the business. What we don't do is impose that on businesses, and really it comes back to we want to be led by the teams that are running these businesses. As soon as we feel like we're in a situation where we are the ones making operating decisions for these businesses, that's a bad place for us to be because we're not in the businesses day to day. And so what we do is offer our support and insight from other experiences that we've had. And if it's a situation where the management team wants to recruit another member of the executive team and they need help finding that person or getting connected to the right search firm, we'll help with that. If they want to do a tuck-in acquisition but don't have the internal bandwidth or capabilities to do that, we'll say, okay, let us help you with that because that's our core business. But what we're not doing is showing up on day one saying, here's our pricing expert, here's our procurement expert, here's our, whatever it is, they're going to start running those functions for you guys. We don't do that.
Okay, great. So you've highlighted some of the things that make firms attractive. Now, let's say that you've found some organizations that you're like, on the surface, this looks great. Are there any qualities, and once you start to dig in, do the due diligence, that set off alarm bells for you, that are warning signs that would perhaps make you lose interest in a firm?
The list of risks or red flags is probably too long to get into here, but it really does come back to what is going to impact the sustainability of the earnings and cash flow of this business, and that could be anything from, it's an industry that I mentioned earlier, an industry undergoing a bunch of disruption where we look at it and say someone is going to eat this business's lunch or could eat this business's lunch because of XYZ. It could be the company hasn't been filing its taxes properly and is going to owe the government a bunch of money that they haven't paid. It could be there is a plant that is sitting on top of a toxic landfill, and at some point the government is going to wake up and decide that needs to be cleaned up, and you don't have a manufacturing plant anymore. So and there's a dozen other things that we end up doing diligence on and going through. But I think what it ends up coming back to is, do we see this business's earnings base as being sustainable, for the foreseeable future, and can we underwrite underwrite that with confidence that there aren't those risk factors that are going to impact it.
Okay, that's great. So we're almost out of time, but maybe one final question around making an acquisition successful. Once you've partnered with an organization, what do you find? What are some of the things that I'm sure there's a bit of a transition period, and for someone who has to date operated very independently, what would you suggest are some of the things that will ensure a successful partnership, and what are some of the things that that founder, owner, or leadership team can do to smooth that interaction with TorQuest Partners?
I would say, I think what surprises a lot of folks that we partner with is actually not a lot changes the day after, in that, if anything, things go back to normal a little bit, and that business has spent 6 months, 9 months, a year plus working on this transaction that we're involved in, and then all of a sudden that stops and they get to go back to running the business normally. And I think for a lot of folks, that's kind of a nice sort of sigh of relief. I think what ends up being, I don't know if necessarily surprise is the right word, but I think what takes an adjustment is the pace at which we want to work and we want our businesses to execute. And I think if you are a founder, an entrepreneur who has owned and run your business over 20, 25, 30 years, I think in a lot of cases, that sort of time horizon ends up being one where, well, if we have a down year this year, or we didn't get to this project, no big deal, we do it next year. And for us, because we have this relatively compressed time frame that we're involved with these businesses, there ends up being a real need to get after what it is we want to collectively get after. And so at least the management teams and the founders that I've had experience with, at the end of the day, I think what the adjustment, at least they've sort of said to me, is not that there was any big change to how the day-to-day business was running, just more that, oh, wait a second, we were always pushing to make sure that the plans that we had were being put in place. And I think that's just different, frankly, than how a lot of family-owned businesses function, in terms of the level of urgency. And so that, I think, does take an adjustment.
Great. I think we have time to fit in one quick question from the audience, which is, if an owner is thinking about their exit, would you suggest that they engage with an investment banker or go it alone, or when would you do one versus the other?
What I'm about to say is not self-serving, because we love having conversations with owners who don't have an advisor at the table. If I was selling my business, I would hire an investment banker 10 times out of 10. And that the caveat I would put on that is, I think a lot of investment bankers have a very templated approach to selling businesses. It's no different than selling your house and hiring a real estate agent. What I think the best investment bankers are willing to be creative and open-minded about how they run their sale processes. And I think making sure that you're taking a very bespoke approach to different buyers is important. It certainly is for us. But having that person at the table who can help shepherd you through what you very likely will only do once, maybe 2 or 3 times in your life, and it is one of the biggest moments or decisions you are going to be making in your life. I think is extremely important, and getting good advice and getting the right resources around to make sure that the business is ready and as prepared as it can be, frankly, I think is extremely important. If to underline that point, we hire investment bankers to sell our businesses that we're invested in every time. And so hopefully that's indicative of
Right.
the value that we place on having that advice around us.
Right. Great. Well, Jonathan, thank you very much for the time that you've invested to speak with us today. And really appreciate the insights that you've brought to the table. Thanks everyone for joining our M&A webinar series. Next week, we'll be speaking with Richard Thomas from Ontario Teachers Pension Plan. Have a great day, everyone, and we'll hopefully see you next week.
Thanks so much, everyone.